It started like a small tear in a sail, hardly visible, easy to dismiss. By the time anyone looked up from their desks, the wind had caught it, the canvas split, and the ship was yawing toward the rocks. On a gray London morning in late September 2022, traders on the gilt desk watched their screens bleed red. Prices on long-dated UK government bonds, gilts, were dropping faster than models allowed. Yields were spiking minute by minute, like a heart monitor in distress. And somewhere far from those trading floors, the most boring institutions in finance, pension funds, were about to trigger a very modern kind of panic, a margin call spiral that could blow through the bond market and take the country's savings with it. To understand those final hours, you need the cast and the mechanism. The cast, the UK government, which had just unveiled an unfunded mini-budget to cut taxes and borrow more. The market, already nervous about inflation and rate hikes, and pension funds managing retirement money for millions of Britons. The mechanism, LDE, liability-driven investing. It sounds harmless. In practice, it meant many pension funds didn't just own gilts. They also used derivatives to hedge interest rate risk and boost returns. Those derivatives, swaps and repos, required collateral when moves went against them. That's where the story turns. For years, LDI had been the quiet success of the pension world. When rates were low, those funds needed ways to match long-term promises to retirees without stuffing every pound into bonds. So they used leverage, borrowing against gilts, entering swaps, to create bond-like exposure while freeing cash to invest elsewhere. It worked until yields jumped. Remember the simple rule: when yields rise, bond prices fall. If you've promised collateral based on those prices, a fall means you owe more. That's a margin call. And margin calls are impatient. They don't care about your intentions. They want cash today. On Friday, the government's plan unsettled the market. Sterling wobbled. The following Monday, gilt yields gapped higher again. By Tuesday, they were racing. On the surface, this looked like investors voting against the plan. More borrowing, more inflation risk, higher yields. Underneath, a feedback loop started. As yields rose, LDI funds received margin calls from their banks and counterparties. To raise cash in hours, they sold what they could: gilts. More gilt selling pushed prices down further, which triggered more margin calls, which forced more selling, and so on. It became a doom loop in one of the least dramatic corners of finance. Imagine being on an LDI desk that Tuesday afternoon. Phone to one ear, counterparty on hold, compliance pinging you for updates, and a spreadsheet calculating collateral shortfalls every 5 minutes. The orders go out: sell this line of 30-year gilts, repo this block of bonds, raise cash. But the market you are selling into is thinner by the minute because everyone like you is doing the same thing. Prices begin to gap. No buyers at the last trade. The next bid is a cliff lower. The models blow up. VAR limits trip alarms. The margin call you thought you could meet by close now needs twice the cash by lunch. And then came the moment that felt like the hull scraping rock. Long-dated yields, the very ones that determine the value of pension liabilities, surged in a straight line. The math flipped upside down. The same hedges that had protected funds for years were dragging them toward insolvency in days. Some schemes were hours from breaching covenants. Behind those screens were real people: the teachers, nurses, engineers whose pensions were invested for decades ahead, suddenly exposed to the mechanics of collateral they'd never see. Markets can tolerate bad news. They cannot tolerate forced sellers. A forced seller has a clock, not a price. And when the market senses you must sell, it steps away. That's why the last hours before the Bank of England stepped in looked less like trading and more like triage. Treasury teams called trustees, trustees called consultants, consultants called banks. Can you extend the window? Can you accept other collateral? Can you fill this at any price? The answers were versions of no. Rules are rules. The collateral must arrive. There's a reason central banks talk about financial stability with such careful diction. Stability isn't comfort, it's plumbing. It's the assurance that when one valve fails, pressure doesn't burst the system. On Wednesday morning, the Bank of England stared at a bond market where the plumbing had become a geyser. If long-dated gilts kept spiraling, pension funds would fail not because their assets were worthless, but because margin math was forcing them to torch those assets to generate cash. In other words, solvent institutions could be destroyed by speed. The bank announced a temporary targeted program to buy long-dated gilts on whatever scale is necessary. The phrase did the heavy lifting. Within minutes, yields fell sharply. Prices recovered enough to let LDI funds meet calls and restructure hedges. The doom loop slowed. The clock added a few precious hours back to the day. It wasn't a bailout of bad bets. It was a circuit breaker installed in real time, with a message to markets. We'll stabilize the core so you can fix the edges. The intervention had a deadline, weeks, not months, and a purpose: buy time for funds to raise collateral, reduce leverage, and widen their liquidity buffers. But the rescue posed the uneasy question every crisis asks: how did we set up a system where the safest assets could become the accelerant? The answer is a stack of small, rational choices. Low yields for a decade nudged funds toward leverage. Derivatives promised efficiency. Get the interest rate hedge you need without holding every bond on the balance sheet. Consultants codified LDY into policy. Banks extended lines and collateral schedules in an era of tiny moves. Then a macro shock arrived. Rates surged faster than the collective memory of anyone who built those spreadsheets, and the rational stack behaved like kindling. There's another uncomfortable truth embedded in those final hours. In high-speed markets, time is currency. If your strategy requires that you meet calls in 2 days, but your assets can only be sold in 5, you don't have a diversification plan. You have a mismatch. I wasn't a fraud. It was a timing strategy disguised as risk management, and it worked until timing changed. For the government, the lesson was fiscal credibility is not a press release. Bond markets don't just price your promises, they stress test your plumbing. Announce large unfunded borrowing in a world fighting inflation, and you increase the chance that your own debt becomes the spark that lights the margin fuse. For funds, the lesson was liquidity isn't what you think it is when everyone heads for the exit at once. Cash is a position. So is prearranged collateral. So is the humility to assume that moves labeled once in a century can happen twice in a week. And for ordinary savers, there's a paradox worth remembering. The panic wasn't about exotic crypto tokens or fringe stocks. It's centered on government bonds, the instruments textbooks call risk-free. They are risk-free if you hold to maturity and no one asks you for cash today. Add leverage, add collateral calls, add a fire sale, and the risk-free asset becomes the fire. When the Bank of England's program ended, markets had calmed, and most pension funds had patched their sails. They posted more collateral, simplified hedges, and accepted lower expected returns in exchange for sturdier balance sheets. The government reworked its fiscal plan. The screens on the gilt desks went back to their sleepy pulse. But it would be a mistake to read the quiet as comfort. What those final hours revealed is structural. In a world wired for speed, the most dangerous risk isn't just credit or default. It's the acceleration of ordinary risk into a margin call before lunch. History rhymes. In 1998, a fund called LTCM learned what happens when small assumptions meet big moves. In 2008, mortgage bonds taught the world that correlations rise when confidence falls. In 2022, the lesson came from pensions. Leverage plus duration plus thin liquidity can turn a dull market into a cliff. None of these episodes were identical. Each carried its own vocabulary and villains, but behind them is the same physics. Pressure builds quietly and releases suddenly. So what do we carry forward from those hours when long-dated yields looked like a panic heartbeat? First, that stability is a public good, and central banks are sometimes the only plumbers with the right wrench. Second, that safe needs a new definition, not just low default risk, but low liquidation risk under stress. And third, that the most valuable thing in finance isn't yield. It's time. Time to think, to meet obligations, to breathe when screens go red. The Gilt Crisis did not become a national tragedy. It became a warning flare. You cannot promise long-term certainty on short-term collateral without planning for the day the clock speeds up. In the end, what saved the system was not valor or vision. It was a pause button, pressed just in time. The next question, for everyone from governments to pension trustees to individual investors, is simple and hard. The next time the wind shifts and the sail tears, will you have built a boat that buys you those few extra minutes? Because in modern markets, a few minutes is the difference between a storm and a shipwreck.